And this will be assigned as homework at the end of class, but let's go ahead and get started on chapter 10. Okay, the first one is, it looks like the most complex one, but it's actually one of the easier ones. And it basically has to do with variances. And it's just that we're just using a simple variance, just the an income variance. So let me zoom in a little bit here. Okay, so here's our budget. So over here on the left, this is our budget. And then these are the actual results over here. Right underneath there. Okay, so, oh, I know I didn't put the line there because it would look funny over here. But anyway, so here's the budget that they thought that they could achieve. Over here's what they actually did. And so the difference between these incomes is the variance. So simple variance, just and this would be an unfavorable variance. So income they were planning on getting was $1 million. And these are in British pounds. So they're getting £1 million. They got 700,000 pounds. So there's an income variance. This is unfavorable for 300,000. And again, that's just a plain old variance problem. Now, when it comes to being a foreign subsidiary, it gets to be a little more complex because now you have to translate these into US dollars. So these are British pounds. We have to translate them into US dollars. Now, we have a budget to translate, and then we also have the actual results to translate. So there's a budget and there's the actual results to translate. Now, in case you're wondering how this is all working out, because I know it looks like there's 5 different ways of doing it. Now, these are the ways that they can actually transfer. These are the different methods that are allowed. Make this one green. We'll make this one turquoise. And we'll make this one orange. Oops. Okay. So we have these 3 different ways of doing it. The first 3 ones here, you'll notice that the translation method is exactly the same. Actual to actual at the budget. Actual to end of period. Projected to projected. And only when you get to 4 and 5 do they actually change. Actual at time of budget, actual at end of period. Projected budget, actual at the end of the period. So these last 2 are both actuals at the end of the period, and 1 each of the other 2. And you may be wondering, well, why? Okay, well, it's kind of breaks down like this. the subsidiary is not allowed to hedge their um, uh, currency. These first three are the ones you want to go with. Let's make those bright yellow. If the subsidiary is allowed, and I'll explain why this is true in a second, then these are the two you want to use. Basically, only those things that are under the control of the subsidiary do you want to evaluate them on. The subsidiary cannot change the market rates for a pound versus the US dollar. They don't have any control over it. They can hedge it if they're allowed to, but if they're not allowed to hedge, then it shouldn't be their problem. Make sense? So because these first three are for subsidiaries that are not allowed to hedge their currency, we don't hold them responsible. These last two, if they do have the ability to hedge the currency, then these last two come into play. It does tend to be a little bit more troublesome here, though, even so, because again, these are estimates. Unlike a regular transaction, say, okay, we're going to sell you 50,000 units at $38 each, or 38 pounds, or whatever it is. There's a definite amount. The problem with hedging for things like budgeting and that is that you don't know exactly what the end amount's going to be. Are you going to be transferring 3 million, 4 million, 5 million? You have an estimate, but you're going to have to make your hedging based on that estimate, and that could be wrong. It probably is wrong. Let's see a crystal ball to some extent. So anyway, now these first three, a lot of times parent companies, because they're trying to coordinate, all the stuff that's going on, for all their subsidiaries in the world, a lot of times they'll do the hedging themselves. And in that case, you use one of these first three ones here. If you don't, if you allow the subsidiary to do their own hedging, then it's down here. Then they're responsible for doing the hedge. Okay. Well, let's see. This actually is, not too bad. It looks bad, but it's not. Okay, so the first one is the actual at time of budget. So this is the rate we're looking for. The exchange rate actual at time of budget from 10. And it's gonna be the same thing here. Hey, got rid of my box. Okay, so we're going to multiply these out. So this is what our budget would have been. I'm going to bold everything. You can see it. Same thing over here. And we'll get the difference. take the actual minus the budget. And so this is a variance of $333,000, and this is unfavorable. Second one, actual at end of period. Oh, here. And copy the whole thing, I think. Copy it here too. Hey. You can kind of see this is even more unfavorable. You knew that was going to happen because it's amplified by being more dollars worth. You know, anything that's unfavorable is going to be off by more dollars. With these that are all the same, you could actually take this. Well, here, sorry. You take the you could just take the 700 on the first three. You could do it by simply taking the income and multiplying it. It won't work on the last two, but oh, did the wrong one. Oopsie daisy. Let's try that again. You know, that's the same as this. For these first three it'll work, but on the next ones it won't. Okay, projected. I can tell you that a lot of times the projected is what a lot of companies will use. They will use the projected because to give the whoever is, you know, the everyone involved basically a fair chance at it and say, look, this is what we're going to use to evaluate you. You know, whatever it does, you know, we don't know, but this is what we do. We use to be evaluated. And for these first three, because they all get translated at the same rate, whatever the rate is, it's always the same. The you know, whether it's favorable or unfavorable will always be the same too. You're simply multiplying everything by the same number. So if it's negative and it's multiplied by the same number, it's going to be negative either way. You know, these are all the same. Down here, you could have a mixed one though. You could have unfavorable up here and then have it favorable down here. Okay. So let's move on to number 4. I know why this looks funny. Okay, number 4. Actually, at the time of budget. Actually, at the end of the period. Okay, again, just multiply them out. Oh, what happened there? I don't know. But now you can take a look at this and you can see why this would be. It's still unfavorable, but you can see that it's better than these other ones. This is negative 242,000 versus, over 300 for these other ones. So it's almost 100,000 difference between them. And why is that? Because this is what it was when the investment was, when the budget was made out. When the budget is finished, it's actually paying off at this higher dollar amount. You're getting more dollars back per the pound than you did here. Okay. And projected. And actual. A little worse off because the projected is a little higher than the actual at the beginning, but it's still less unfavorable. And here's the thing too, though, it goes both ways as far as evaluating someone's performance. And what I mean by that is you want to actually evaluate them at what they're doing, right? Not over things they don't have any control over. So you don't want to have it necessarily tainted by the fact that the market for the dollars went up or down. They have no control over that, and if it ends up a plus or a minus, it really isn't their fault. They don't have any control over it. These last two, they actually have control over, so that's why these last two. That's why these last two are. Oops. You can get these kind of wilder swings in it because in these last two, they are responsible for it. That makes sense or no? It's not too bad. I mean, it really is just a matter of, and you do this for any of the variances. Hey. Oh, line color. And so, and these down here, they do have control over it. That's not what I meant to. Yeah, I know it is what I meant to do. Yeah, let's pursue that. Okay, so there's a problem in your textbook, problem 10, that's very similar to this one. Okay, next thing we're going to go to are the net present value problems. So this is, yeah, I'm sure you guys had this in your managerial classes on the net present value. And I'm just going to go through a little basics on the net present value, just a little refresher, shall we say. Get used to using the tables. I know people say, well, I got this calculator, they can do it. I just punch in this, and this, and it gives me the answer. You're not going to have that on the CPA exam. In fact, most of the other exams, you're not gonna have it on either, if it's CMA or whatever. You have to learn how to use those, the tables and what those factors do. So anyway, using the tables is something you get to understand. A pretty good chunk, at least of the CPA exam the way it is now, is on present value stuff. And for a good reason, because whenever you take something from the future, how do you value it? How do you value a piece of equipment? How do you value a building? How do you value all these things? And you do it by taking future amounts and discounting them back. So we're just gonna have a little refresher course on this. I know you guys have had it in other classes, but okay. So these are I was calling the grandma cases. Okay, I'm gonna bold all this. Grandma promises to pay her grandchild $1,000 in 3 years. The discount rate is 6%. What is grandma's gift worth today? We have two different tables. We have the single payment. Do I have it all set up as what I do? The single payment table, and then we also have the annuity table. You guys probably already have used both of those. Annuities when there's multiple equal payments. So grandma's not going to give us multiple payments. So grandma's just going to give us one payment. So let's see here. We have 3 periods. The rate is 6%. The table is single. The factor. Okay, 3 periods. 6%. 0.840. Okay, so we're going to take grandma's payment. Let me do it down here, maybe. Times the factor. Equals what grandma's gift is worth. So this is what grandma's gift is going to be worth to us. It's going to be worth $840. Oh, I see. What just happened? Hold on. Okay. There we go. So that's what grandma's gift is worth today. Okay. Grandma decides to pay house repair grandchild $1,000 in 5 years. Rate is 10%. Table is single. The factor is 5 years. %. Line 0621. I'm afraid 0.621. Okay, so why is grandma's gift $1,000 gift less? What made her? They're both $1,000. Why is number 2 less than problem 1? Nobody? It has to do with the interest rate. The higher the interest rate, think about inflation, the higher the inflation rate, the less the money's worth. And the longer the period goes on, you'll notice that these all go down in value. Hey, I got 2 problem 2s here. This would be problem 3. Okay. All right. I'm around the side here. Which one's better? That one. And this one again, the interest rate changing actually changed our answer. So the reason why these are different is so changing the discount rate can change your answer as far as which is better. And the first one, the 5 periods was better. Second one, 3 periods is better, just because of the change in the interest rate. Okay, we're going to use the single payment table on this one. Fred promised to pay his nephew $1,000 each year for the next 3 years. So the rate is 8%. Table is single. And the factor at 8% is 3. So what is the gift worth? The gift is worth $2,577. Now, because these are all the same, this is actually an annuity. Annuity has equal payments, as long as they're all equal. A lot of things in business are. So because these are all equal, that's actually an annuity. And what we can do if we have an annuity is we can add the factors up. Oh, here we go. And just multiply it once. And we should get that same number, and we will. So an annuity says that everything, that these are all going to be the same multiplier here. So we can just add up all the factors and then just multiply it once. And an annuity at 8% for 3 years, you'll see is that. So an annuity, we can use the annuity table. You can always use a single payment table. This table you can always use. Single payment table you can always use. The annuity table can only be used if you have an annuity, if they're all the same. If any of these numbers are different, 1,000, 2,000, 8,000, or whatever, then you can't use, and you have to use a single payment table. But you can always use a single payment table. And if they're an annuity, you can use the annuity table, and you use the annuity table because it's a lot quicker. For instance, down here, Uncle Fred pays his nephew $1,000 at the end of each year for the next 7 years. The rate is 6%. Table could be either table, but we're going to use the annuity faster. And so we go to 7 periods. $6%. Oops. And again, we could have done a single payment table. We could have done this 1 through 7, but it's just quicker just to do it once. The annuity table. Janet wins the lottery. It's a $2 million lottery. The money's to be paid to her at a rate of $100,000 a year for the next 20 years. Discount rate is 8%. What is the lottery winning worth today? Okay, period's 20. Rate is 8. Table could be either one, but we'll go with the annuity. And the factor is 8%. I know I keep jumping like this because this is a what's not, why is it jumping like that? This one. There's the troublemaker. Okay. Okay, so 8% for 20 years, 9.818. Times 100,000. $981,000. You know, why don't I make these into we can read. $981,800. Okay, Janet is not a millionaire, but she's probably very happy. And this last one down here. This is more of kind of what we're going to look at today. And at Sam's Organic Bicycle Shop, the owner offers to sell the bicycle shop to Sam for $600,000. So, you know, let's say you graduate and you're working as a manager in a bicycle shop or something like that, and the owner says I'll sell it to you for $600,000. The shop will earn approximately $100,000 per year for the next 15 years, and the discount rate is 8%. If you don't know what the discount rate is, you know, if you're in a situation, whatever the bank can loan you money at, it's a good one to use. Okay, so 8% for 15 years. Okay. 8,559. Ooh, whoa, whoa, whoa. And this is for $100,000 a year. So this is the value of the place. If you can get the cash flows and an interest rate, you can value anything. Now, would you pay $600,000 for something that is worth $855,000? Yes. It's worth 855,900, so you would definitely buy it for 600,000. And the minute you bought it for 600,000, you'd be $255,000 better off. I know you guys have seen this before. Okay. Net present value is very similar to the last one we just did. Are you guys okay with these, or do you need help with these at all, or not really? Is it boring you to tears? All right. Okay. Problem 8, or problem 9, excuse me. Okay, so here's what we're gonna do with this. The investment is worth the negative inflows are 1,000. Times that, so these are positive. Hmm. Apparently I have word wrap on here. Oh, wait a minute, I don't want to do that. Okay. So this is the net present value, and as long as this is positive, you would accept, you make the investment. As long as this is positive. Okay, do the same thing down here. One second. Okay. Number 11. This is not an annuity. They're not equal. Can't use the annuity table. So we have to use a single payment table. All right. Well, I'm going to be lazy and copy this down here. So this would be the my investment is negative 30,000. We're going to get these. Inflows. And so this will be our net present value. Okay, so this is this would be a yes. It's positive. And we're in the same boat down here. We have these. So these are inflows. 12%. We're on the annuity table. No, we're not. We're on the single payment table. What am I doing here? Single payment table. It's not an annuity. This would be no. It's negative. You'd be losing 28, 65. Okay, let's go ahead and take a break. We'll say be back at. Seven oh eight. I'll finish up this handout and we'll go on to the next one. Okay, well, problem 13 is the same thing we did before. Calculate net present value. I'm just gonna do it right on the table here. 5 years, 8% is an annuity. $3.933. 993. And this is, oops, let's try that again. This is our initial cash outlay. So our net present value in Canadian dollars would be that. Okay, now here's the problem though. We have an exchange rate of 0.76 at the current rate, and the estimated average over the next 5 years will be 0.68. So we're gonna have to multiply these by these two numbers. So initial investment will be done today, so it'll be a current rate. This will be averaged over 5 years. So that will be our net present value. Okay, so that would be for A. I'm gonna copy all this down here for B. I think it'll be exactly the same, except for B. It says, what if this was 0.81? What would it look like? Notice that it would jump up considerably. So all we're doing is taking the initial investment at today's market rate and then trying to figure out a projected average. Estimating an average of what you think that it's going to be going into the future, and use that to evaluate the investment. And are you going to get it wrong? Probably. I mean, you don't have a crystal ball, but you have to have something to make to decide that investment. Okay, down here's a similar one. 4 periods, 12%. This will be annuity. $3.37. And just like we did up here. Oops. Now, the exchange rates are 0.71. And down here we have, sometimes we'll do an estimate based on probability. And that's what we have down here. There's a 10% chance we think the rate will be about 60, 50% chance it'll be about 70, and a 40% chance it'll be about 80. So what we're going to do is multiply these out. And we're going to get a weighted average. So 0.73 will be our weighted average for the years. And for all of these, it'd be a yes. They're all positive. So this 0.73, this number. It's a weighted average. So here's the probabilities. These should add up to 1. 100% basically. And they do. Okay, that's it for that one. Hey. So let's go ahead and value added tax. This will be this is a short one. So the difference between sales tax, value added tax, and withholding. In the United States, we usually use sales tax. And sales tax only apply when the item is sold. So until it's sold, you don't have sales tax. So let's say that we had something that was manufactured, could be in the same, it could be in the United States, could be somewhere else in the world. But they manufacture it, goes to a wholesaler, goes to a retailer. Maybe we own all 3 of these. We don't get taxed until it's sold for sales tax. So here's the sales tax, 10%. Everyone knows how that works. So the customer, if they pay $1 million for something, they're going to pay 10%, $100,000, and that will go to Uncle Sam, go to the government. A tremendous amount of the world works with value added taxes. And value added is sort of like your income on the transaction. Even if it isn't sold to the end user. So when the manufacturer sells something, this isn't lining up here. No, that's not lining up. Okay, so the value added will get taxed a lot of times. So here's a value added tax of 10%. So those $100,000 of value added, 10,000 will be paid for the value added, which is sort of like income, but it's really not income because this really isn't a sale. This is just a transfer price. So notice the next group, they will add in that value added tax. So the transfer price is 610. Notice that's different than up here. You have to add that value added tax in. So now it's 610 coming over here to the wholesaler. Value added is 190. You got to pay 19,000. Okay. So we have 800,000. Plus the 19,000 value added tax. So there's a total of 819,000 the cost of net income. In this case, it was sold. So there is net income now. And if it's still in a value added tax country, it would still be value added tax. If it's not, if this is in America, you have sales tax. So it's possible that you have these value added taxes and then also this income tax up here of 100,000. So that would be a pretty heavy tax bill, as you can see. But this way, the tremendous amount of the world works with value added tax, not sales tax. It's similar to like an income tax, but it's applied more like a sales tax. Okay, we talked about this a little bit before. Just wanted to throw this in there. This really isn't related to those two up there. But withholding taxes are withheld from dividend payout by local governments. This is not the same as the withholding for your payroll check. Withholding for your payroll check is still your money. It's just the government's holding on to it, and you'll see how much it gives you back in a refund, or else you owe an additional. But this is, unfortunately, they have the same name. So this withholding taxes are in foreign countries, especially, are for dividend payouts. So if they pay you out a dividend of whatever, $300, and it's a 10% withholding, then they'll withhold $30 of it. Okay. Give me 1 second, and I will send out the multiple choice. Okay, you should have gotten multiple choice now. So go ahead and fill in the poll and we'll get the extra credit points. Call it a night. who is answering E? And no, there's no question. Those are obviously not okay. Is anyone still working on this? Oh, here we go. Okay, we're getting something. Are you still working on? Well, I'm gonna throw out the D, the E, and no one is okay. So let's go ahead and I'll close them. Okay, close the poll. I assume nobody else is doing it. Okay, first one, B, yes. Two, yes. Three, yes. There is no E, by the way, whoever put E up. And there is a question four. Okay. Value tax. Yeah. Good. Okay, so Vico got 4 million, paid 25 for it. No, 2.5 million, I'm sorry. $300,000. See, yep. Okay, good. Six. There is no question. Yes, there is. How is a foreign subsidiary different from a foreign branch of a domestic corporation? Good. A branch is still under the same corporation as the parent. Number seven. Who did that? Which one of you guys did that? E. There's no E. All right. Well, the national corporation may attempt to minimize taxes, but will then a higher fixed rate and transfer. Why is this often not successful? Um, well, that was the first one. Yeah. Okay, good. Laws in foreign country may prohibit such a scheme. Yeah, governments aren't stupid, so they, I mean, every time someone thinks they're doing something smart, uh, get around paying taxes, more often than not, it just triggers something else, either tariffs or duties or excise taxes or something. When is the primary difficulty of using market-based prices for intercompany transactions? B is right. It's hard to tell if there's something specific that you're putting in the product that, what is it worth? Nine, which cost will be minimized by sending a low transfer price? B, yeah, right. Yep, import duties. Lower import, because they're based on a percentage of it, usually. Cost method is appropriate when actually it's the last one here. The related art is more than simply distributed goods it purchases. In other words, it works them in some different way that it would be it's not the end product. Okay, very good. Close the poll. Okay. Well, so what I'm gonna do is I am going to send out the, let's hold off on this chapter 10 textbook problem. We'll hold off on that one. And you should get that pretty quickly here. Like within 10-15 minutes. So I'll send that out, I'll email that out, and you have until a week from Friday to turn it. Save this. Okay, ooh, that's not me. It's not me either. That's me. All right, so I will see you guys in a week, and the test should be in your email within probably like 15-20 minutes or something like that. And I'll be due in a week from Friday. Questions? Okay, have a good one.
Have a good night.